Okay, good morning, all of you. Sunday morning and waking up at 8 o'clock for the GST session itself requires a lot of courage. And I'm really glad that I could find 90 participants and it will be surely increasing. So yes, today we are here for the last session. That is, we had a 3-day webinar over here on real estate on the GST series. And today being the last day, I welcome our today's esteemed speaker, CA Sunil Gabhawalla sir, and dynamic Vice Chairman Rajesh Agarwal sir. Now I'll ask Rajesh Agarwal sir to please address the audience. Over to you, sir.
Thanks, Pranav. I welcome Sunil sir, esteemed faculty of the session. Sir, we have scheduled this series of 3 days for real estate in 3 parts. One is revenue part of the profit and loss account. One is expenditure part of the profit and loss account, and structuring of the transactions. That is joint venture development agreement and all. So really thanks from Pune branch sir for accepting our invitation. For this topic, there was no faculty like you. That's why we requested you to take this session. And because law is not clear on many part, there is ambiguity with respect to the provisions. So I request Pranav to continue, please.
Okay, thank you, sir. So I'll be quickly introducing our today's speaker, CA Sunil Gabhawalla sir. Sir's topic today would be GST implications on joint development agreements, TDRs, FSI, and long-term leases. Quite a very interesting and a required topic and the need of the day. Sir is a chartered accountant in practice with third rank at All India level. He is also a cost accountant and has an excellent academic record throughout his career. Sir started his career in indirect tax practice in the domain of sales tax law, and in the early days of his career, he even worked on the clients from transition basis from sales tax regime to the VAT regime. Sir has been into writing and has published one a comprehensive treatise on service tax, which has saw 23 editions. Sir is actively involved in the policy formulation process of GST and keenly follows the development in regards to the emerging law. His YouTube channel contains various topics and has garnered more than 60,000 views. He mentors a pan-India community of indirect tax professionals on the front of GST implementation. Throughout his career, he has been taking several seminars and has been a speaker at various important uh, platforms. He is an SN accredited trainer and regularly conducts training sessions for development and the departmental officers. In the early days of his professional career, he has also taught tax concepts to management students at different colleges. Sir has been writing articles into the professional and business journals and into various newspapers. He was the president of the Bombay Chartered Accountants Society for 2018-19 and is currently the chairman of the Indirect Tax Committee of the said society and is also the member of study group constituted by Maharashtra Tax Government for implementation of GST. So with such a great background, sir, it is indeed our honor to have you here at Pune branch of WIRC for this session. I welcome you from the entire branch, and without wasting a lot of time, quickly I hand over the session to you. Over to you, sir.
Thank you, Pranav. Thank you, Rajesh, Vice Chairman of the Pune ICAI branch. It's indeed a pleasure to be speaking to the professional colleagues on a very emerging topic, as rightly put out by Rajesh ji, on the real estate sector. And I was really happy to see the way the entire program has been structured in terms of one day discussing the output side of the revenues, the second day discussing the expenditure side, and then looking at the overall structuring of the transactions. And to some extent, what I would be speaking today would also be a bit overlapping with what you have been studying in the earlier 2 days. And those topics, I would try to cover it up a little bit faster, but it would be important to set the context. With that little bit of a background, let me share the presentation and we can go through the slides one by one and try to understand this ever emerging topic of real estate. What are the indirect tax implications there? And those who are into a long-term practice of indirect tax would know that this is one sector where there has never been a dull moment. Right from 2004-5, when there was an entry for taxing contractors for service tax. The entry was for known as category called construction of residential complex, and it typically sought to tax contractors. And there, at that point of time, there was also a debate of whether only labor contractors would get covered or even works contractors would get covered. But not going into that controversy, the department was overzealous, and based on one Karnataka High Court decision which went into the Supreme Court, the department from that day onwards has been debating and trying to impose a tax on the developers and the builders. And that's, I think, the starting point of that entire debate, where the attempt was made to classify a developer or a builder as a contractor rather than looking at the economic essence of the transaction, that he is a seller of an immobile property. And therefore, I think this route of 2004-5 may also be an important basis to start our entire discussion. And that mindset has continued over the last 2 decades. We have seen lots and lots of changes. In 2007, the works contract entry was introduced to make it very clear that even the works contractors would get taxable. Ultimately, the Supreme Court held that it's only from 2007 that they could be taxable. 2010, an explanation was introduced, and through that explanation, the sort of a legal sanctity was sought to be given to the Supreme Court observation that once a property is sold, then the developer steps into the shoes of a contractor. He changes the color from being a developer to a contractor. That is when an explanation was introduced in 2010. 2012, the list of declared services continued to include the sale of under construction units. We have 2017 when GST is introduced. That concept of sale of under construction units being taxable continued under the GST regime as well. And this was attempted through a Schedule 2 entry. And as we are aware, Schedule 2 provides for classification, and this has been clarified in 2018 through a retrospective amendment. Along with Schedule 2, you also have a Schedule 3, which excludes specifically sale of land and sale of building. Of course, that is made subject to Schedule 2. And therefore, one will have to really look at the interplay between Schedules 2 and 3 to really make a sense out of this entire aspect of taxation of real estate sector. And while all of this was brewing, and there was a challenge of the profiteering element involved by the builders and the anti-profiteering authority trying to take some positions. In 2019, to do away with all of that, we brought in a new scheme of taxation for builders and developers, which typically said that there's a concessional tax rate against which there is no liability to no eligibility towards claiming input tax credit. Of course, all of this before one point or one milestone could get settled and resolved, we have tried to move fast into the second milestone. And therefore, most of the issues which we will be discussing are open-ended and they would overlap with each other. And this is, I think, the broad legislative background within which we will have to look at the entire real estate sector. Now, when I'm looking at this real estate sector, as has been said, today's session is more on the type of transaction structures which exist in the real estate space and the GST implications in terms of interposition of the situations with each of those types of transaction models. And therefore, we need to understand who all are the stakeholders in a typical real estate property. Let's say you buy an apartment or you buy a bungalow and it's under construction. Who all are the stakeholders involved in that entire process? And for this august audience, we all are aware that there are around 5 to 6 minimum stakeholders involved and groups of stakeholders. At times, you might have more than one in any of these boxes. The center point of this entire discussion would definitely be a developer who would be recognized as the chief promoter under the RERA and who would be entering into agreements for sale with the buyers and who would be standing out in front of the buyer to say that, look, come what may, I will be giving you the possession of my promised property on this date. And yes, you have to pay me this money. Naturally, so that's a transaction between a developer and a buyer which always is undertaken. And that's how you would really look at who the developer is. Because in many cases, you might find that nomenclature may be a little bit complicated, but the point, how will you analyze the tax implications? I think the biggest starting point would be to say who is entering into an agreement for sale, who is committing that yes to the buyer that yes, I will find out a land for you, or I have already found out. I will make sure that it has a good title. I will invest whatever money is required in the interim. I will appoint contractors, get the work done. to get the work done. I need n number of approvals. I'll follow up with the government to get those approvals. And end of the day, by let's say 31st December 2024, I will be handing over to you the keys of your dream house. I think that's the person who will be named as a developer. And the developer will keep on coordinating with different agencies like the landowner, the person who owns the parcel of land. Maybe he sells them outright, maybe he gives them on a joint development agreement, or different types of arrangements are possible between the landowner and the developer, which we will go into in a few minutes. There would be a financer, and at times the roles might get blurred. The landowner and the financer might be similar or the same party. At times, the developer himself might be a financer, and there would be another contractor involved in the process. So the roles can, as far as the financer is concerned, the roles can get a little bit blurry, but this is a person who invests the capital for the entire project during the period up to which you are getting the money for that entire process. Thereafter, you have a contractor who will actually bring in his labor and people and the various materials, and he would actually go ahead and do the construction. Firstly, if there's an existing premises, he'll get it demolished. Thereafter, there would be, the foundations being laid, then thereafter the construction being done. And the government will have both an active and a passive role in the entire process. A passive role in the sense of giving approvals, and an active role in terms of encouraging various things. And for doing all of those aspects, the government would be raising various revenues, many of them in the nature of taxes and fees or cesses. And at times it would also be in the nature of some user charges. And that's where, again, at some point of time, we will have to discuss the tax implications of the various charges which have been levied by the government or the government agencies. So I think these are the broad parties which one will have to look at when we are looking at the overall business model as far as the real estate sector is concerned. With that little bit of a background, we go into the first aspect of this entire discussion, which basically would revolve around the relationship between a developer and a buyer. I am aware that this relationship has been talked about in the last couple of sessions in detail, so I am not going to go into that into detail, but just a couple of points to set the ball rolling, because when we go into the other aspects, the questions at times will come is whether those would be treated as a section of a sale of an under construction unit eligible for 5% without ITC, or whether it would be the normal tax rate, and what would be the valuation. So when we are going to discuss all those aspects for transactions between the developer and the landowner, it may also be important to first understand and be clear about what are the tax implications of a transaction between a developer and a buyer. Simply put, the transaction between the developer and buyer is simple. He has a plot of land, he has certain approvals in place, and he approaches a buyer to say that, look, I will construct this property for you. I will sell this flat to you. This is the unit number of the flat. Let us enter into an agreement for sale where I commit to give you an undivided interest in the land and the completed flat, and I will convey the property in favor of a cooperative society of all the prospective buyers. And when he does this type of a sale of an under construction unit, he also lays down a stage payment. He says that because I can't stay invested, I will need the money in these many stages, X percentage on this date, Y percentage on this date, and so on. He keeps on receiving this consideration as and when the work is getting completed during the progress of the work. And at the end of the project, there is some amount which he gets on possession, the granting of possession, and the keys are handed over and he exits the project. This type of an example where the developer supplies the flat along with all the paraphernalia attached in the flat against a monetary consideration is a transaction which we are anchoring. Now, when we are analyzing that transaction, as I said, right from 2004-5, the attempt of the government or the department has been to categorize these types of developers as contractors, especially if the transaction of sale of the immovable property of the flat has happened prior to the receipt of the completion certificate, or as we loosely say, the occupation certificate. And in the service tax regime, the attempt was done to treat it as a service, and under the regime also the classification is proposed under the classification of service. And that's where I think we need to understand what is meant by this word service. And if you look at the law, section 2102 gives a very wide meaning to the word service. Of course, there is a long attachment to it, but in essence, the service is defined to mean anything other than goods, money, and securities. Now, having said this, the department therefore has a very open canvas. And what the department typically tries to say is that when you say service means anything other than goods, money, or service, we want to cover the entire universe under the concept of service. They would say that, look, when you sell a flat, is the sale of a flat of goods? And the answer is obviously negative. It is definitely not money or securities. And therefore, the department would say that because a flat being a sort of an immobile property is neither goods, money, or securities, therefore it is a service. And that thought process continues in Schedule 2, Entry 5B, which, as we all know, specifies that a construction of a complex, building, civil structure, or a part thereof, including a complex or a building intended for sale to a buyer, wholly or partly, except where the entire consideration has been received after issuance of a completion certificate, whichever is early. So here we are told that this will be classified as a service. And thereafter, Schedule 3, Entry 5 tries to carve out certain activities as neither supply of goods nor supply of services. And it says that a supply of land and a sale of building, a sale of land and a sale of building will be excluded and will be treated as neither a supply of goods nor a supply of services. Now, when we are talking about this, please note the word used here is sale, and therefore there has been an interpretation of how do we interpret this word sale vis-a-vis the wider word supply, which is the subject matter of taxation. We'll come to that when we go to the FSI TDR transactions. But right now, what is also important to note is that the exclusion for sale of building is made subject to clause B of paragraph 5 of Schedule 3. Now, having said all of this, the key point which will come up is how will we still interpret the definition of service? Is our starting point of discussion that GST is a tax or a universal tax on everything under the sun? Is that a correct interpretation? Or is there some boundary to the taxation under the GST law? And that's where I think even when you go to the Constitution also says GST is a tax on supply of goods or services or both. Nowhere does it stop by saying GST is a tax on supplies. And therefore, the basic starting point of section 2010 to say that service means anything other than goods, money, and securities closes the possibility to say that there could be anything other than goods or services. And I think that is a fundamental flaw in the way the word service is defined. And when service is defined in such an open-ended manner, the question which comes up is, will the judiciary interpret the word service to really mean the entire universe? I'll give you a very simplistic example. Let us say the law defines an elephant means a four-legged animal. Would it therefore mean that a giraffe becomes an elephant? This is, or will you still say that when elephant means a four-legged animal, it would mean elephants and other species of animals which are similar to elephants? The essence of the original word, especially when the further definition is very, very widely given, will have to be looked at. And that's where I feel that whenever we look at the word service means anything other than goods, it doesn't mean that the entire universe will get covered. It would still mean that you are defining service to mean something which is in the nature of a service. The essential general parlance meaning of service cannot be done away with. And we have a Supreme Court decision, Hari Prasad Chaurasia, which in the context of retrenchment compensation takes a similar view. Even in Venkateswara Hatcheries, there is a similar view which has been taken. So when a definition is given in a manner which really does not convey anything, one will still have to go to the general parlance and the essential meaning of the word service. And the general meaning of the word service would not, within its general meaning, undertake the character of a supply of an immobile property or a sale of an immobile property. Therefore, I would believe that Schedule 3 is not a strict, only these many things are outside the purview of GST because of being an immobile property. You could still have other activities relating to immobile property. If those transactions in immobile property do not bear the character of a service, then it cannot fit within the definition of service. It cannot fit within Schedule 2, Entry 5B. More importantly, recently Schedule 2 has been made a subject matter through a retrospective amendment, has been made a subject matter of classification rather than a deeming fiction. And therefore, one cannot be guided by Schedule 2 to decide on the taxability. The taxability will have to be decided on the fundamental factor of whether the transaction constitutes goods or the transaction constitutes supply of services. And a view is definitely possible that a supply of an under construction unit is neither a supply of a goods nor a supply of a service. K-Raheja, of course, has been a law, but it applies only in very specific types of situations, and it was related to a works contract law. Maybe under the GST law, to what extent it will apply is something which is still a subject matter of debate. Even the service tax levy has been a matter before the Supreme Court, and we'll have to wait for a Supreme Court verdict on it. Of course, a lot of water has flowed thereafter. Therefore, in my view, there is a possible legal view to say that even a transaction of sale of under construction flat simpliciter does not amount to a service, and therefore there is no liability towards payment of GST on a sale of an under construction unit. Another important aspect to look at, and this has been time tested right from the income tax decision of BC Srinivasa Setty, we have Ganga Saran's case of the Supreme Court, and recently we have Suresh Kumar Bansal's case. And all of those decisions lay down one important parameter of taxation. And we all are aware of this parameter of taxation, that a charging entry has to be very strictly construed. And whenever you are looking at any charging entry, that charging entry depends on a few pillars of fundamental substantive provisions. For example, the timing of taxation, the value of taxation, and the rate of taxation. Unless there is a crystal clear clarity about these aspects, all these decisions lay down that the levy itself fails. For example, Suresh Kumar Bansal says that unless there is a very clear mechanism to define the value of the underlying land, you cannot split a composite contract and demand a tax on the service component thereof. And this is where the question which comes up is that through a notification, a sale of under construction unit is defined to bear a GST rate of 7.5%, and through an explanation we are told that we will give you 1/3 deduction for the purposes of land, and we are not given an option of identifying a value of land and reducing that. And recently the Gujarat High Court has held that this type of an ad hoc deduction for land valuation through an explanation to a notification is unconstitutional. That is just a week-old decision, and a lot of discussion has happened on that. In my view, it's a very correct decision. And if we fall back on that principle, assuming I have a composite contract, and of course the Gujarat High Court decision, the facts were very different. There were two agreements, one for sale of land amounting to 85 rupees, and another for the supply of the construction service amounting to 15 rupees. Department said, I will add 85 and 15, make it 100, give a deduction of 33, and demand a tax on 66. And the Gujarat High Court said that this type of an interpretation is not possible. Since there are two separate contracts, the 85 rupees cannot be through an explanation added into the value of the construction service. The construction service is an independent contract for 15 rupees only, and it will have to be respected. And now, while it is limited to this aspect of split contracts, I believe the principles it lays down are very important. And if you have a single contract of 100 rupees, the question which comes up is that you cannot provide for an ad hoc deduction through a notification. It has already been held unconstitutional by the Gujarat High Court. And there is no other mechanism given under the law to define a value of the land in case of a composite contract. And if that has not been given, perhaps the levy itself fails. One can go back to the L&T decision wherein it was held that 2007 is the time when works contract became taxable. Through a notification, 33% deduction was given for 2004 construction category, and it was held that between 2004 to 2007, in the absence of a very clear identification mechanism for the land value, for the material value, the works contract services could not be taxed. I think some similar interplay can happen as far as simple sale of flats is also concerned. Further, one important aspect which came up in this decision of the Gujarat High Court which was being discussed time and again, was the Supreme Court decision. The entire basis for taxing under construction units and treating the developer as a contractor comes out of the Supreme Court decision of K. Raija, which is reported as Larsen and Toubro's decision. And that Supreme Court decision lays down some principles. What are those principles? It says that when a developer constructs a undertakes a project and he starts developing that project, getting approval, starting the construction work, he does all of it for himself. There is no two doubts about it. If he does it throughout the process and after constructing that entire property, he sells it, it's clearly a sale of an immobile property throughout. There's no issue. And I don't think even the current law anywhere tries to touch upon that aspect in any manner. But if in the interim, between the initiation of the project and the completion of the project, if the developer enters into a sale agreement and sells the underlying interest in the land or the land to the prospective buyer, and accordingly the land becomes the property of the buyer, the Supreme Court says on that day, on the day the agreement for sale is entered into, the developer changes his role. He changes his role from being a developer of an immobile property into a situation where he becomes merely a contractor, a construction contractor for, and this is important, for the pending work of construction still to be done. And therefore, the Supreme Court also at some places says that till that stage, the incomplete work, the construction activity undertaken till the date of agreement for sale is a part of the sale of immobile property along with the sale of the land. It's only the pending construction work which becomes a subject matter of a works contract because he steps into the shoes of the contractor on that interim date, on the intermediary date. Now, when this judgment came up, most of the VAT laws were amended to specifically provide for a stage-wise deduction. To say that, okay, if you enter into a contract for sale agreement on day one, and they specified some stages, we will presume X percentage of the contract value to be the under construction value, and everything balance would be treated as the the sale of immobile property. And that kept on changing based on the various stages of development of the property. In Maharashtra, we had MVAT rules 58, which specifically dealt with this type of a table. The service tax law did not deal with this type of a table. And when GST came, service tax law took precedence, and therefore the service tax law does not have any table. There is no deduction given for the work completed in case of intermediary sales. So to cite an example, if I start a project in 2018, because of COVID, the project gets extended. I have been doing work. I have not been able to sell anything till date. But the project is still not completed. It is likely to complete by December 2023 or December 2022, maybe 6 months down the line. Maybe the slabs and all is over, but a lot of other work is still pending. And today I sell a property. The point which comes is for the construction activity or the value which has been completed till today, there were no two parties involved at all, and therefore there cannot be a service element up to today. And a substantial amount of the value which I am going to derive will be for an activity which has already got completed. And therefore, even if we respect that Supreme Court decision and say that yes, it would apply in the GST law, the question which comes is there is no deduction given or a carve-out given for already completed before the transaction of sale. And because there is no such deduction, you cannot treat me as a contractor for the entire flat. It is only some component of the flat which is pending on the day I enter into an agreement for sale, and therefore the levy fails. Another interesting aspect of the service tax and the GST law is that the entry nowhere touches upon this concept of agreement for sale, which is the fundamental aspect of the Supreme Court decision. What this entry touches upon is the fact of receipt of money either before or after the completion. We have where there is a payment of advance received against an allotment letter. but that allotment letter does not transfer a legal title in favor of the buyer. And if no legal title is transferred in favor of the buyer, then the observations of the Supreme Court of putting me from a developer to a contractor do not apply. And therefore, this entry itself is fundamentally in discongruence with the Supreme Court decision and the settled interpretation of what constitutes an immobile property and what does not constitute an immobile property. And therefore, it's likely a possible legal view can be taken that there is no liability towards GST. If we say that, maybe a lot of the discussions which we do today may become redundant. And as we all know, a more conservative view, especially considering the fact that GST is an opportunity cost, you could collect it from the buyer and pay to the government. Most of the developers would want to take a conservative view and say that yes, sale of under construction units is liable for GST. But I just wanted to highlight and sensitize this participant profile to an alternative possible view, which I would believe is a strong possibility, considering the developments which have been happening over a period of time. Having taken a conservative view that yes, there would be a liability towards GST, we are aware that post 2019, the entire entry has undergone a fundamental change, and we'll be primarily talking about this entry post 2019, wherein we are told that affordable residential apartments in RREP would be liable for 1% GST. Other residential apartments will be 5%. Commercial apartments in a RREP would be 5%, but other commercial apartments in a non-RREP would be 12%. And again, affordable residential apartments in a non-RREP would be 1%. Other residential apartments in a non-RREP would be 5%. And ongoing projects would be given an option. If you choose that option, you can go with the old rates of 8% and 12%. These concessional rates, as we are all aware, come with a very important condition. Credit should be claimed, and this entire tax should be paid only by debiting the cash ledger. And to ensure that people don't make unnecessary benefit out of this entire process, builders and developers were told to reverse proportionate credit through a very, very complicated formula as on 31st March 2019. Because no input tax credit is available, a natural business tendency would be to procure from unregistered dealers. Therefore, there's a notification which says you pay an RCM on shortfall of procurement of less than 80% from registered dealers. And then there's a guidance given to say that you will maintain project-wise, financial year-wise records and discharge these liabilities accordingly. All of this, I'm sure, has been discussed in one of the earlier sessions. So we will not go into too much of detailing of that. One important aspect which comes up is the impact of cancellations. Again, when you look at it from a conservative perspective, because many a times what happens is there are two main means through which a cancellation happens. One is the flat is resurrendered, the agreement itself is cancelled, and the flat is resurrendered by the buyer back to the developer. In this situation, the question which comes is the tax GST which was already paid, whether it can be adjusted or refunded. In my view, if you look at section 34, which provides for a situation of a self-adjustment of tax, it talks about situations of non-provision of service or a deficiency in service. In many cases, the cancellation is because of financial difficulty at the hand of the buyer. Now, if that be the situation, it will be difficult for the developer to satisfy the conditions of deficiency of service or non-provision of service or a rejection of goods. And therefore, in my view, section 34 does not get satisfied. GST credit note cannot be issued, self-adjustment will not be allowed. Whether there is a non-provision of service or not can be an interpretation by itself. One can take a view because the agreement is cancelled ab initio, the transaction did not fructify, and therefore there is no service. And therefore, one can say that either the developer or a buyer can claim a refund. I would believe it may be more appropriate for a buyer to try his luck to file a refund claim rather than a developer getting involved into this entire process. Another, of course, one thought process which many people have is to say that the deficiency in service is wide enough to cover this type of a scenario and you can issue a credit note. Otherwise, you can file a refund application also. But I would go by the conservative view which has been mentioned. If there are transactions and transfer fees levied by the developer, they would be liable for GST, naturally at the rate of 18%. And one other aspect which comes up is if especially there's a price escalation, the buyer might receive some compensation for a price escalation. I would believe that there is no element of service given by the buyer to the developer, and further it is not in the course or furtherance of the business of the buyer. And therefore, the profit which is earned by the buyer is more in the nature of a capital profit, is not in the nature of a service, and therefore should not be made liable for GST. We have the fundamental challenge whether the input tax credit can be denied. With the Gujarat High Court decision, perhaps there's much more stronger argument to say that restriction of input tax credit through a notification is constitutionally incorrect. I think that was just a little bit of a rebrush of what you have studied over the last couple of days. We now go to the main agenda for today, which is the discussion on the development agreements. And this is where we look at the situation of the transactions between a landowner and a developer. And as we know, there are various different modes in which this transaction can happen. It could be an example of a simpliciter joint development. It could be an example of a cooperative society appointing a developer to undertake a redevelopment project. Sometimes a cooperative society might undertake a redevelopment itself and itself might become a developer. There could be a tenanted premises wherein there can be a tripartite agreement between a landlord, a tenant, or a group of tenants and a developer. There could be a slum rehabilitation project wherein a private land or a government land is encroached by slums and the SRA chips in to provide some properties for the project affected people. And there is a free sale area which is available for sale and a development agreement which demonstrates and legalizes all these processes. So different variations, and to guide you on each of those things, let me start with a fundamental aspect. At times, I've seen many times we try to intermingle these different facets of redevelopment or development. Please note, each of these have very different types of legal implications, and therefore each of them have to be understood differently and after looking at the legal and the statutory background of each of the decisions. For example, in service tax law, there was one circular and that thought process has continued till date, wherein there has been an attempt to compare redevelopment and SRA on similar metrics. One fundamental difference between a redevelopment and an SRA is that in a redevelopment, the member or a tenant owns the property or the transferable tenancy rights. Whereas in a slum development, there is only a protection to stay. There is no transferable development rights or transferable ownership rights or tenancy rights available with the slum dweller. And that, in my view, can change some of the interpretations which have been canvassed on the situation of taxability of slum rehabilitation. We'll go into them as we move into the detailed discussion. And I think this is what is a caveat which we need to bear in mind, that each agreement, each transaction will have to be looked at separately. One cannot generalize the end results or the answers in these types of very complex scenarios. Let us now go to the first case, joint development or simpliciter transaction between a landowner and a developer. There could be various possible scenarios, and typically the arrangement the landowner would supply, and that is the starting point of the discussion. The landowner would supply either a land, maybe undeveloped land, or a partially developed land. At times, it may be a developed land which is in a dilapidated condition. At times, there may not be a transfer of a land, but merely a transfer of a development right. So, and this is where we try to distinguish between a sale of land and a grant of a development right. And we are aware of this broad matrix. And this is what typically a landowner would bring into the system. At the same time, the developer would try to bring in various roles and obligations, and he would compensate the landowner for the grant of land or the development rights by way of any or one or more of these mechanisms. And what are they? First is, of course, a cash. It could be a lump sum one-time cash. It could be a variable cash in terms of percentage of the gross receipts. It could be a share, which is sharing gross revenue. It could also be a share in the net profits. That is one mechanism in which the developer can compensate the landowner. The other mechanism is to provide a developed area, and that developed area is meant for the self-use of the landowner. And this is very common, especially if you are owning a bungalow and you want a redevelopment done. What you would do is, you don't have the money to put in. You will appoint a contractor. You will tell him that, look, instead of this bungalow, you can make a 5-6 floor building and 6 units are there. You give me 2 units for myself, and I will use it for, I have 2 sons, and so 2 units for me is enough. And balance 4 units you sell in the open market. So that type of a situation where the developed area is awarded to the landowner for self-use. The third situation is if I have a huge plot of land, I will not be happy with 2 or 4 flats. I will want, let's say, 30% of the flats or 40% of the units, a developed area. And if I am as a landowner wanting that much, I will naturally want to further sell it. So that is a scenario where the landowner is given developed area of reasonable quantity for further sale. So this is the type of the consideration which typically flows from the developer to the landowner. Now, depending on the combination of the supply and the consideration, you can have different types of arrangements which can happen between the two. What we will do is we'll try to discuss the implications of GST on both those fronts separately. When it comes to the supplies by the landowners, I think the first situation is a sale of land or supply of land. It's clearly excluded from GST. Schedule 3, we already discussed that. Supply of partially developed land also would stand excluded from GST because the fundamental principle or the definition of land would not only include land, but anything which is appurtenant to that land in terms of development. Of course, I am aware that there are contrary advance rulings on this, but my view on this is very clear that if you are selling a partial lock, stock and barrel, it would still be excluded from GST. K. Raheja also would support this type of thing. That brings us to the third and the most controversial area, wherein the landowner does not sell the land by himself. I think there is some question from Sri Krishna Gupta. He has raised his hand.
Sir, we will cover at the end.
Okay, sure. So the third scenario is a very commonplace scenario wherein through the development agreement, a development right is granted to the developer. The landowner says, no, I don't want to sell the property, because if he sells the property, most of the developers don't have money to give on day one. The landowner is a little bit worried that, look, my title is no longer with me. And if that developer says that I will pay you, let's say 100 crores after 3 years, but he does not pay anything, then what do I do? And therefore, landowners typically want to ensure that the title in the property is transferred or conveyed at the latest point of time from his legal security point of view. And therefore, what he does is, I allow you to enter the premises, I allow you to develop the premises, I allow you to obtain approvals, I allow you to get a property constructed, I allow you to sell the property, I allow you to keep the money. And all these rights which I'm giving you, I am giving you under a bundle known as development rights. And this is known as a grant of development rights under the development agreement. And you give me these many things because of this. So long as you satisfy those tests, I have no rights. I am giving you an irrevocable power of attorney also for that purpose. But if you do not honor your commitments, the agreement would provide that the landowner will have a right to step back, come back into the process and go back on the contract. Now, this is where I think the question which comes up is whether when I am granting a development right, wherein I am giving away everything other than just a legal title in the property, whether that constitutes a sale of an immobile property, whether that constitutes a sale of a land, I would believe that yes, a grant of a development right is as good as a sale of land and therefore should be excluded. And there are a couple of supporting points on this as we move into the discussions. We'll go into that when we discuss FSI and TDR. We will go into that Cheda housing, DLF, a couple of decisions holding that point of view. The Maharashtra Land Review Code itself defines land to include rights in land. And therefore, there is a strong possible view to say that development rights is as good as a sale of land and therefore is excluded from the purview list. While this controversy was there, the department was trying to tax these transactions and was trying to treat the time of supply as day one. And the logic for that was that the supply of a development right happens on the day the agreement is entering. And they typically, therefore, most of the joint development agreements saw a huge contingent liability on the date of the inception of the contract itself. That's where I think the industry represented to the government. And in 2019, amongst various changes, one change which was brought about was to bring in a reverse charge mechanism on development rights. Now, please note, and when we go again to that entry, we'll go into a bit more detail. The RCM notification tries to bring in an RCM in favor of the promoter, which is basically the developer in our example, only in case of transfer of development right and a sale of FSI or additional FSI. And those words are very important. It uses the word transfer of development right. I would believe there's a difference between the word transfer of development right, which in industry parlance is known as TDR, and a grant of a development right. To understand these words, we need to go into the development control regulations, DCP, wherein the word FSI is defined. And we all understand FSI. FSI is nothing but the ratio of the built up area to the area of the plot. And there are regulations which say that for a particular type of a plot, certain amount of FSI is a permissible FSI, and which is a basic FSI, which we always say. The regulations in certain cases also permit additional FSI or fungible FSI or premium FSI. Different words are used in certain situations. Now, each of them is against a payment of some amount to the government. Now, that is as far as the FSI is concerned. Now, what is TDR? TDR, again, the DC rules specifically uses this word TDR. TDR is denoted by a development right certificate. Now, in some cases, the developmental authorities want to get certain public infrastructure developed. For example, the slum has to be developed, and therefore, or a parking area has to be developed, or there is a rehabilitation required for the construction of a bridge. In all these cases, the government or the developmental authorities will get this construction works done, and either they could pay money to the contractors, or they can give an equivalent FSI. And this equivalent FSI is given by way of a development rights certificate, which is freely transferable. So the contractor can take these TDRs and he can transfer those TDRs to some third persons. Now, the question is whether the RCM notification covers a joint development agreement or whether it restricts the coverage only to this transfer of development rights, which are equivalent to a grant of an FSI by the government. So one is the FSI granted directly by the government. Second is I buy the TDR from the market and load it onto a project. Does the RCM notification cover only those areas, or does it cover also the notional value of a landowner, trying to grant a development right? So I would believe that it's more of the situation of only TDR getting covered and not a grant. The word grant is not specifically used here, and it's important that it is not used. And the law is not expected to avoid certain words, and being a charging provision, each charging provision has to be strictly construed. Therefore, there is a possible view to say no GST is payable. Having said that, a conservative view looking at the notification would be to say, don't go into the distinction between transfer versus grant. The RCM notification 5 of 2019 entry 5B uses the word development right. Let it be granted, let it be transferred. The landowner is giving some rights to the developer, and therefore the transaction will be liable for GST under the RCM. Again, even if it is liable under RCM, it is the responsibility of the developer, not the liability of the landowner, because landowner is clearly excluded from the purview of the GST because of this RCM. Also, through a notification 6, a concession has been given that the tax has to be paid at the time of occupation certificate. We are also told that the tax is payable only to the extent of unsold inventory on the date of occupation certificate. Of course, there is no specific provision on valuation. There are two views. Either you can take the market value of the FSI being granted or the development right being granted, or you can take the value as per para 2A, which has been provided under the explanation to that notification. So that explains the aspect of the supply by the landowner. To summarize that discussion, I would believe the supply of land and supply of developed land also is outside the purview of GST clearly. As far as sale of development rights is concerned, there is a strong grant of development rights is concerned. There is a strong ground to say there is no taxation. Even if a conservative view, tax has to be paid by the developer at the time of receipt of completion certificate, proportionate to the value of the unsold inventory. Now comes the second facet, of the same transaction of the joint development agreement, which basically is about the consideration by the developers. And the question which comes up is whether this consideration, in case of cash, share of gross revenue, share in profits, these are all fixed or variable considerations in cash. Clearly, transactions in money excluded, no issue. But where the developer is returning some developed area, the question which comes up is whether this developed area itself is to be treated as a supply. Now, and therefore, whether the transaction is more in the nature of a barter governed by the purview of the GST. Now, to answer this question, I think it will be important to distinguish between scenarios where the developed area is given for self-use versus a scenario where the developed area is given for further sale. And why is this so important? Because of the entry 5B, which is construction of complex intended for sale to a buyer will be governed by the purview of GST. Therefore, if we are able to establish that there is no intention to sale of the area which has been allotted by the developer to the landowner, in that case, one may perhaps argue that entry 5B itself is not applicable. A litigative view also would be to examine whether a barter of services is covered under section 7.1, whether consideration definition deals with barters and non-monetary consideration, and whether entry 5B, the way it is worded, covers situations of barters. I think these are some questions which one will have to bear in mind, and perhaps one may try to take a view as far as the free area given by the developer to the landowner is concerned. The conservative view, as provided by the series of notifications of 2019, is that the tax is to be paid under forward charge by the developer at the time of the occupation certificate. The value is to be as per para 2A of notification 3, wherein we are told that the value of construction service shall be deemed to be equal to the total amount charged for similar apartments in the project from independent buyers. Now, this is important, from independent buyers other than the person transferring the development right, nearest to the date on which such development right or FSI is transferred to the promoter. So while you will take up the nearest transaction and pick up the equivalent market value, you will thereafter apply the tax rate and pay it. The tax will be paid only on the date of the occupation certificate. Having said that, there could be a possibility of a tax on the developer on the date of the occupation certificate. The implications about taxation on the landowner if he is further reselling. Again, as far as the landowner is concerned, he is not undertaking any activity of construction. Even though he is selling or reselling a unit under construction, he is still a reseller. He is not a construction contractor in any way, and therefore, sorry, a possible view is that there is no liability towards GST, sorry, since there is no activity of construction involved in the process. Of course, again, a conservative view would be to charge GST to the end buyer at the hands of the landowner, claim input tax credit of tax charged by the developer, and therefore, because there is a very specific explanation which permits the landowner to claim the input tax credit of the tax charged by the developer, and by doing this, you are actually bringing in a conservative view with a commercial sense, because it in a way brings in a commercial parity between the landowner sales and the developer sales, and it also reduces the risk of the landowner of litigation. So therefore, many organizations would prefer this type of a conservative view as far as the landowner is concerned. That takes me to the next variation of a joint development, which typically would be an example of a redevelopment undertaken by a cooperative housing society. Again, this is a scenario where you will see there are lots of interpretation issues coming up. Before we go into that, maybe we pause for a few minutes. I'll maybe just give me 5 minutes and we'll come back at 9:05.
Friends, in between, if we have any question, kindly put it in a question and answer chat box. We will take the sessions at the end.
Also, participants, if you have any particular topic in mind which you think should be covered at Pune branch level for any upcoming webinars or live sessions, you can definitely drop a note to Rajesh sir or to me.
Friends, we have hosted one more GST series on litigation, which covers the day-to-day part, that is reply to ASMT, reply to notices, covering summons, investigations, departmental audit. I have just put that in chat box, details of the program. You can register from Pune branch website. The faculties and the coverage is vast, yeah, and faculties are excellent. You can check. In 3 days itself, we have covered maximum part of the litigation part, except you can say search and survey, prosecution. 2-3 parts we excluded because these are not required in day-to-day time. But other parts we have covered.
Okay. So I think we'll continue with our discussions. We've tried to discuss the joint development agreement. We tried to discuss the simpliciter sale of under construction units. Now we go to a variation of joint development, which is a redevelopment project. And especially in cities like Mumbai and Pune, where the land available for development is very limited, you find many examples of redevelopment projects which have been undertaken. And this is something which has got attention and fancy of most of the developers and also most of the cooperative societies. All of us are aware of how the entire process works, but just for the sake of simplicity, we'll try to put it down in a chart. There's a cooperative society already into existence. It might have, let us say, 10, 15 members or 20 members. There's a building which is a 40-year-old building. They have been staying there over so many years. The building is now in a bad shape because of the efflux of time. The building is nearly like in a position that it needs a new development. The context also has changed, but the existing members do not have money to pump in and redevelop and undertake those type of fundamental repairs. And that's where a type of a partnership arrangement in the form of redevelopment comes into place. The cooperative society scouts for a developer and tells them the same thing what the landowner told to the developer in the earlier example. He says, the cooperative society says, I'll give you this land. We are 10 people here. We have, let us say, each of us has a flat of 1,000 square feet. We are interested in getting a flat of 1,500 square feet. So please give us a flat of 1,500 square feet. I'll give you this property. You break this building, you create a new building. Each of us, you give us a building of a flat of 1,500 square feet each. You give us some money so that we could bear the future maintenance, because naturally the future maintenance will be higher, which is known as a corpus money. You also give us the rent for 2 or 3 years for which we will stay somewhere else. And once you do that, we give you the consent. And what you will do is over and above the 10 flats or the 15 flats which you are going to give us, including the extra area, whatever is the surplus area, you can sell in the open market. And you can take money from those new buyers and keep it for yourself. So this type of an arrangement of redevelopment is a scenario which is a very commonplace scenario, where a developer will come into a picture. He will invest into the cost of construction of the existing members. So let's say there is a cost of 10 crores which he is incurring for that. He will also incur various costs for approvals, TDRs, FSIs, contractors, etc. Let's say 30 crores. So his project will have a construction cost of 30 crores and 10 crores of construction cost for existing members. So 40 crores ka cost. He estimates that he will collect 50 crores from the new flat buyers because he will have some saleable area. And naturally on this 50 crores, he would pay the GST. According to him, his P&L is very simple. It's 50 crores of revenue, 40 crores of cost, 10 crores is his profit. 50 crores. If he sells under construction, he will pay GST. He would prefer the conservative view and pay GST like what we had discussed earlier. If he sells post occupation certificate, naturally there is no GST and there's no debate on that. The question which comes up is this life as simple as we can see it over here? Because there is no input tax credit, assuming he buys only from registered dealers. There's no input tax credit. So where's the question of any other issue here? The issue which comes up, and as we all are aware, is an interpretation of a barter. And the department would want to say that, look, you are looking at a payment of 10 crores or the incurring of construction cost of 10 crores as a cost. But for me, this is not really one leg of a cost because there are no free lunches in the world. This is actually a transaction between a developer and an existing member or a society, which is in the nature of a barter. If you can see the earlier slide, I have shown only one arrow, which is that I am incurring a cost of 10 crores and I am giving free flats to the existing members. The department would say, no, there is no free lunch. You are not incurring a cost of 10 crores. This is actually a barter. And there are two legs to it. The first leg is where the member gives development right. And the second leg is in consideration of the development right, the developer is giving a flat. And therefore, the department's perspective is that both these legs of the barter, firstly, these legs are created to say that this is a barter, and both these legs of barter become taxable. And naturally, both those taxes, because of the notifications of 2019, the taxes are payable on the date of completion certificate. Both those taxes are payable by the developer because development right, the liabilities under RCM, we already talked about it only to the extent of unsold inventory. And for the developed flats, again, there is a tax because it's a free area which has been given. And again, a view is being canvassed that being a barter, this becomes liable for GST. Again, the question which comes up is the same, that can this entry 5B schedule 2 cover situations where the complex is intended for sale, or will it cover all situations of construction of complex? Especially considering the fact that the existing member is never interested in selling the unit which has been developed for him. One more aspect which one needs to consider is whether the granting any development right to the developer, because it's actually the society which owns the rights in the land and not an individual member. And therefore, it would not be correct to say that the member is granting a development right. Please understand, the mutuality principle has been given a go away by way of a retrospective amendment in the CGST Act. So member and society are distinct persons. An individual member does not have any right in the land. And if he does not have any right in the land, he could not grant a development right. The development right, if at all, has been granted, it has been granted by the society. And the society does not in any way receive the construction service from the developer. And therefore, one important aspect which one has to look at is whether this is a very straitjacket basket to say that, look, this is like a person would have either paid 1 crore and bought a flat. Instead of that, this person is giving some development right and he is getting buying a flat. Firstly, is there a sale? Is there a buyer involved? These are questions which will have to be addressed at some point of time. Another way to look at it is to say that the definition of consideration can be paid by a third person. It is wide enough to say that a consideration can be paid by a third person. Now let's understand this from a very simplistic example which we might want to take. Let us say there are a group of 3 friends. All of them go to a restaurant and they consume a dinner. And one of the friends pays for the dinner. Does it mean that there is a service given between the other 2 people and the restaurant? The answer clearly would be in the negative. Now, this example, what stops the department from saying that, look, the restaurant gave free food to the first and the second one, and somewhere bring in an agreement to do something or something by A and B and try to impose a tax on it. Can one not say that this is a scenario where, though the construction is done for member 1, the consideration for that is paid by member 2 being the person who is buying the flat? Because end of the day, if you look at this entire scenario, the entire 10 plus 30, the entire cost is recovered and inbuilt into the 50. And this is what the tribunal in the case of Vasanta Green and also in the case of Ethics Infra recently have held. What it says is that for the transaction with the existing members, the developer is actually incurring a cost, and this cost cannot become a revenue. What can be taxed as a supply is only a revenue, not a cost. And I think that's a very valid interpretation to make. And therefore, there is a very strong line of argument to say that there cannot be a tax. Of course, we already talked about the conservative view. The notification would say that there will be tax at both the legs, and this is something which will be a subject matter of a long-drawn litigation. To avoid that type of an uncertainty and litigation, most of the societies nowadays are also evaluating an option of a self-redevelopment. And in a self-redevelopment, typically the developer steps into the shoes of a consultant. The development is undertaken by the society itself. And I think this becomes a sort of a simplistic structure to say that, yes, in this scenario, there is no free area given to anyone. And therefore, there cannot be any question of any taxation on this front. That takes me to the last aspect of discussion for today, which is relating to the grant of FSI and TDR. Now, again, we go back to the same discussion to say that services means anything other than goods, and the exclusion under Schedule 3 restricts itself to the sale of goods, but that by itself does not mean that the word service is wide enough to cover everything. FSI would still continue to be in the nature of a right in a land, and this is what has been held in various decisions, right from DLF to Chheda. We have Sadodai's decision, Bahadur and others versus Sikandar and others. All of these decisions holding that a right in a land is as good as a land itself. We don't need to go very far. Look at Regulation 34. It says the development potential of a plot or a land may be separated from the land itself and can be made available to the owner of the land in the form of transferable developmental rights. Section 216 of the Maharashtra Land Revenue Code says land includes benefits to arise out of land, things attached to the earth or permanently fastened to anything attached to the earth, and also shares in or charges in the revenue or the rent of revenue, villages or other defined portions of the territory. So all these definitions are wide enough to treat this as the transaction of FSI as a transaction of a sale of land. Having said that, we are aware of these entries which talk about a reverse charge mechanism in the hands of the developer, the tax to be paid at the time of the occupation certificate based on a value of the nearest flats and only to the extent of the unsold inventory on the date of the completion certificate, and restricted to the output tax of the unbilled inventory. So of course, all of this we are aware of. One more aspect which we need to bear in mind is whether in many cases the FSI is granted, let's say by a society or by an individual landowner, whether that grant of FSI is in the course or furtherance of business, especially if the landowner is treating it as a capital asset and not as a stock in trade or as a business activity of himself. So I think that these are some of the points from my side. Maybe we have a few questions, so we can over to the organizers to look at how we want to address those questions. Yeah, Pranav. Would you,
So are we going to take questions right now?
Yeah, we can start taking questions. And would you want to unmute that person and allow him to ask the question? How do you want to deal with the questions?
I'll read out the question, sir.
Okay.
Okay. So there's one question. What about change in the flat? That is, if there's a cancellation and one flat and the other flat has been taken with extra facility. Nandini, if you could, yep. Nandini, if you could please complete the question. Okay,
रेश्मा, नंदिनी गुप्तांना हे करा, अनम्यूट करा.
Unmute, yep.
Nandini, directly ask the question.
Okay, by that time I'll take one more question, sir. Can you please explain in detail GST payable on TDR and FSI under reverse charge mechanism?
Okay. So basically, as we saw in the presentation, there are 3 or 4 steps. Now, I am assuming that you are taking a conservative view and you want to end up paying a tax on the TDR or the FSI. If the tax is to be paid, the mechanism of payment would be that you will trigger it under the reverse charge mechanism. Therefore, the transferor of the TDR or the FSI or the development right is not liable to pay GST. The supplier is not liable. It will be the promoter developer who will be required to pay the GST. The GST would again not be payable at the time when the payments for this FSI or the TDR is made, but it would be payable at the date of the completion certificate. When the completion certificate of the project is received, only at that point of time the tax will be payable. The tax will be payable on the value of the FSI or the TDR at the rate of 18%, but the tax will be only to the extent of the proportion of the unsold inventory. To give you an example, if the value of the FSI TDR is around 1 crore of rupees, there will be 18 lakhs of tax. But you don't have to pay the entire 18 lakhs. You have to pay only a proportion of that 18 lakhs. What is that proportion? The proportion will be the proportion of the unsold inventory on the occupation certificate date, the completion certificate date, divided by the total developed area. So let us say you have taken a construction of 50,000 square feet, of which you have 40,000 square feet is sold before completion certificate and 10,000 is remaining unsold on that day. So you will say 20% is unsold. Now 20% is unsold. So you will say that 18 lakhs you have calculated the tax. You will not pay 18 lakhs. You will pay 18 lakhs into 20%, which comes to 3,60,000. I hope I'm clear up to here.
Yes, sir. One
Yeah.
more question.
No, I'm still not. This is not the end. This is one calculation which you will do. 3,60,000 is the first calculation, which is proportionate tax to the extent of the unsold inventory. The logic is that for the sold inventory, you have paid 5%. So again, you should not pay other tax. For the unsold inventory, you have not paid any tax. So please pay this tax. Now, in some live example, it might so happen that the 5% tax on the unsold inventory could be less than this proportionate tax. So if the 5% of the unsold inventory is less than the proportionate tax, you will pay only 5% of the value of the unsold inventory. That is how the entire notification has been worded. So I think that completes that entire discussion. Yeah.
Okay. So
Yeah,
in
so
case of
I am able to unmute. So should I?
okay, yeah, go ahead.
So regarding the first question, my question was regarding cancellation of flat, where we said that cancellation still is subjected to section 34. But what about a person booking a flat unfurnished and later he cancels it and takes a furnished flat in the same building? So still, could we cover it under the section 34 because of a deficiency of service, or without any extra facility where he's booked first floor then takes the 10th floor? So still do we consider cancellation provisions?
So here there are two facets which comes into picture, Nandini. One is an example where there was no registered agreement entered into, and the transaction before the swap happened on an allotment letter or on some other informal unregistered document. And the registration itself happens for the 10th floor flat or the furnished flat. In that scenario, I think one can argue that this is a scenario of a change in the service itself, and therefore there is no cancellation at all. It's just a change or in the mind while the activity was happening. But if you have already registered the first agreement, then you will have to look at how are you doing this entire arrangement. Are you canceling that agreement and creating a fresh agreement? If you are doing that, then they become standalone transactions unless you are taking care to link all the three transactions together.
All right, thank you.
Any further question, Nandini?
I think I posted one more question. If you could
You
take
can
that,
ask.
then
You can ask quickly. No problem.
okay. So I'd ask one more is
Yeah.
can we also call the landowner promoter as a promoter?
See, landowner promoter would be a promoter for the purposes of RERA. But if you are looking at my presentation today, there is a concept of developer. Now that developer concept is very different from the concept of a promoter as defined under RERA.
Okay, but it uses the word only promoter.
Yeah. So landowner promoter can be a promoter if there is no developer involved in the process.
Okay.
So I might have my own plot of land.
So you mean to say if a TDR is purchased by a landowner, he is not supposed to pay reverse charge. If a TDR is purchased by a developer, he is supposed to pay reverse charge. Then isn't that an anomaly?
No, I am not saying that. I am not
Okay.
saying that.
Okay.
I didn't understand, and in fact, I was going to ask you the same question, that in what context are you asking?
Yeah, this is the
this
context.
question? Okay. So firstly, we need to understand that when you talk about landowner being a promoter, from the perspective of GST, you have to first look at the transaction structure. Are we having two parties involved, landowner and a developer, into the picture, or is it a single party? Because in many cases, I might have my own piece of land and I might undertake a development and sell flats on that plot of land. Then clearly I'm a developer, I'm a promoter for the purposes of GST. Is that the example which you are talking about?
It normally is a tri-party. There's a power of attorney, there's a developer, and power of attorney is given to the developer. He develops the land. However, the landowner doesn't believe in developer getting, getting the FSI properly. So he might enter into that. All FSI I will bring, all TDRs I will buy, but you need to construct.
So there is a joint development agreement between a land. If I have understood your facts well, there is a joint development agreement between a landowner and a developer, wherein though generally the developer brings an FSI, instead of the developer bringing in the FSI, the landowner takes the obligation to bring in the FSI and loads it in the development right, which is granted to the developer.
Yes.
And therefore it's an obligation of the landowner.
Yes.
And your question then is, what happens to the landowner?
Does he need to pay reverse charge? And if yes, then again reverse charge through the TDR value. There also there is an increase. So isn't it double time also?
Yeah. So in this context, I would believe that the developer is the promoter, the landowner is not a promoter, and the RCM entry typically applies for the entire chain, imposing a tax only on the last leg. So just to give you an example, if A sells FSI or TDR to B, B sells to C, C then sells to D, who loads the TDR. Then it's only D who will pay RCM. For A, B, and C, all of them would be outside the purview of GST.
Okay, sir. I'll then come back to valuation. It's okay. You can take other questions. I'll get back to you over an email. There are other valuation questions in this also.
Sure.
Thank you.
Okay. Thanks, Nandini. So in case of joint development agreement of commercial project, transfer of development rights from landowner to developer is taxable at what rate and on what value?
So yes, of course, in a commercial project or even in a residential project, there would be a tax implication, and rate would be normally 18% proportionate. Here, of course, the proportionate concept will not come into place, and the value would be as per the ready reckoner value, whichever is the value on the date of the transaction.
Okay. In finalization of accounts, can we show advances received which are in the line with completion of building as sale and remaining value as WIP, as GST sales shown in GST returns will now reflect in 26 A's as well?
I think this would be an accounting question. My primary answer is no, you can't do this, but I am not an expert on accounting.
Okay. What if land is being sold through sale deed for consideration of area? What will be the tax implications?
I think we did address this in my presentation. As far as the sale of land is concerned, there is no tax at all. For the area which has been given, if it is not for self-use, one may like to pay the tax and claim credit at the landowner level. If it is for self-use, there is an argument to say, based on Vasanta Green and other decisions, that this is not a taxable transaction.
Okay.
One question from Dilip Kitawat. Whether plotted land with essential amenities like water, electricity, severages, etc. is taxable?
According to me, no. I think there are contrary advance rulings on this front. But according to me, you have to have a building or a civil structure Just because you are developing a land, it would not by itself result in a liability towards GST.
If a tenant surrenders his transferable tenancy rights received, one flat free of cost, that is barter, and no consideration is the intertransaction, how GST is payable by the tenant or is it payable by the builder?
So as far as the surrender of transferable tenancy rights is concerned by the tenant, according to me, there is no tax liability. I am aware that there is a circular which says that there is a tax on that. But personally, I would believe that there is no tax for two important reasons. One is a transferable tenancy right is a transaction in an immobile property itself. And secondly, in most of the scenarios, the transaction is not in the course or furtherance of business. And therefore, there is no tax on the transfer of tenancy rights by the tenant to the developer. When the developer gives back a completed premises back to the tenant, again, there will be a controversy. A conservative view would be to pay tax on it on the date of the occupation certificate. A more possible legal view, as we have discussed, is to again rely on the decisions of Vasanta Green and Ethics Infra and say that this is more of a cost for the developer rather than a revenue, and therefore there is no GST implication.
Okay. Anil, if you could please ask your question.
Yeah, sir, I have two questions. Hello.
Yeah. Please
First is, if a flat is booked in 2016, wherein service tax is paid, then GST is also paid during 2017 to 2021, and flat is cancelled in 2022, and same flat is resold in 2022 again. What is the GST implication for developer, and whether it is a double GST?
Yes, I would believe that there is a problem here. You are saying that in 22 also the property is under construction.
Yes,
so therefore,
yes.
On the second sale, you will have to pay GST. On the first transaction, you have kept on paying service tax and GST from time to time. I would believe that there is no mechanism to offset that GST against the second GST. Whether you want a refund of that first one or not, whether that refund will be available is a subject matter of interpretation, because you are saying that typically in a case of an under construction service, the KRAIJA says that the service is rendered on the principles of accretion. So the accretion kept on happening over a period of time. Therefore, establishing a non-provision of service or a deficiency of service is going to be very difficult. And therefore, it's going to be a tough task for the developer to claim a refund of the GST paid on the first transaction. Double taxation is likely to happen. At the most, I would suggest the buyer can file a refund application separately and try his luck.
That is fine. Now the second question is, hello?
Yeah, please go ahead.
When flat is booked when project is 50% complete, can we take analogy that 50% already completed construction is not a service rendered, but a sale of immovable property?
Definitely. The Supreme Court decision says so. Go back to the GST Council minutes, wherein Maharashtra has raised this objection to the scheme of taxation which was introduced in 2019. It has been reported very well in the Gujarat High Court decision recently. All of that clearly suggests that 50% cannot be taxed. But having said that, the notification or the rules have no mechanism to exclude this 50%.
So sir, to reconnect to my earlier question, when the flat is cancelled and that same flat is resold, so resold is only after that 50, 70, whatever percentage was already completed. So I need to pay 30% GST only, collect and pay 30% only, because 70%.
Not because it is a resale flat, but because you are challenging the basic notification which says that everything will be taxable.
So I have to pay again first on a when cancelled, I have to pay GST full. Again, I have to pay full GST on a full.
Unless you want to challenge on the grounds of KRAIJA.
Okay.
And it's a much larger call to challenge KRAIJA.
Okay.
See, I'll give you another example. What you want to say is, because 50% was received in the old thing, It was
First
already
buyer, from first
first
buyer.
buyer. To that extent, it is already completed. So therefore, when I sell it again, I
Yeah.
will say that the value should be only balance 50.
Yes, yes.
But on that day, you are also selling a fresh stock. On the fresh
Fresh
stock,
stock.
also, will you take the same position of paying tax on the balance 50? Answer is
And
no.
then, so it means 100, I have to pay again 100. And earlier, supposing it
Yeah.
was 70%
Unless you are
complete.
wanting to challenge that KRA decision, rely on KRA decision and challenge the entire structure of the GST law.
Okay. But what happens here, the flat is identifiable. So is it not an unjust arrangement on the part of government that are supposing 3-4 times it is get cancelled and rebooked. So on the same flat, same services, you are charging 3-4 times.
So it's again goes back to the root of the entire issue, Anil. You have to check whether you are taxing a service or whether you are taxing a transaction.
Yes.
Right. In this scenario, let's look at a stamp duty. There is, of course, that 1 year waiver and other things. Otherwise, if there are 4 transactions for the same flat, you pay stamp duty 4 times.
That is fine. It is a separate issue. But what about GST part?
No,
Sir, it is alimony.
Similar issue come here.
It is specifically mentioned. It is alimony in the law. There is no specific provision in the law to give the benefit.
Yeah, that is true. But you see, can we envisage that on one flat, 100 rupees, you charge 5% every time? So you are collecting effectively.
Sir, you are correct. I am not denying your concern. Anil sir, I am not denying your concern. You have to pay 3 times or 4 times. But if it is covered under 34, you can give the credit note and take the credit.
But that is again, okay, coming to that, deficiency of service means if supposing he is delaying the project, say for 5 months, I can say it is deficiency of service. Supposing slab-wise payment is to be made and slab is delayed, I can say it is deficiency of service.
Maybe yes, but in many examples that's not true. Many examples it's a financing problem of the buyer, or a buyer wants to exit the project. That's all.
Yeah, but
There's
in
no
case
general
in case it is there, so that slab is delayed, so it is a deficiency of service, or it is project is getting delayed because of corona or any other reason, can we say it is deficiency of service?
It will go on the facts. If there are delays and those delays are documented, and because of those delays there is a cancellation, maybe one can take a view that there is a non-provision of service. There's no deficiency but a non-provision of service.
And second part, will that 18 months credit note period will trigger, or it is a continuous service so that you can give credit note at the after the last transaction within 6 months?
No. A moment you say it's a continuous supply of service.
Yes.
Each continuous supply of service is deemed service to the extent that an invoice is raised or the milestone is triggered.
Okay, so credit note date start from that day, 18 months or 6 months after the end of the year.
Yes, for each stage payment, the credit note date will start from that day.
Okay, so it is continuous service. Continuous service will not help us saying that the last payment which I was supposed to make and not made, date is starting from that day. No, not that way.
No, it can't work that way.
Okay. Okay. Thank you, sir. Thank you very much.
Okay. So coming to the next question. RCM on unsold inventory is limited to 5% of cost of project or output liability on unsold inventory?
5% of the output liability on unsold inventory.
Okay. What is the position of GST on rent or compensation charges paid to landowners for a period of construction? Does this change in case of commercial projects?
So when you are paying a compensation or rent to the landowners, this is not against a service which has been given by the landowner. This is only a valuation mechanism or a transaction in money for the development right. So I would believe there is no tax implication on this.
Is GST payable on FSI taken from sanctioning authority?
So
For
here
example,
again,
PMC.
yes. So here again, there is a notification which says that any activity undertaken by a local authority by way of a regulatory aspect under Article 243W of the Constitution will be treated neither as goods nor as a supply of service. Now, if we look at the situation of grant of FSI, it is one of the most important regulatory aspects of a local authority. And it is a part of Article 243W as being a part of the developmental process. If one goes by that argument, then there is no question of paying any RCM on this transaction.
If the developer purchases TDR from third party, still GST will be paid under RCM?
Yes, the developer will have to pay under RCM.
Trading in TDR is taxpayer business. What is the applicability of GST on trading of TDR, both conservative and legal?
So if a person is buying and selling TDRs, on the sale of TDR, he would be selling it to a promoter and reverse charge would trigger. And therefore, he has no liability to pay tax on his own.
In a development agreement, landowner gets 25% of area as well as cash consideration. How to treat cash consideration while discharging RCM tax liability by the developer if at all units are not sold before the completion?
So this has been explained earlier that you will find the value of the development right, which includes both this cash as well as the area components. And you will find a proportionate tax to the extent of the unsold inventory on the date of the completion certificate. We took a numerical example to explain this earlier.
In case of joint development agreement with society, can builder demand GST on construction services provided to society members?
This again we have discussed. There are two decisions already, Ethics Infra as well as the Vasanta Green decision on the case of society redevelopment. Builders want to take a conservative position and therefore they would insist at times that either the society pays up this tax or gives an indemnity. So I think it's more a commercial issue between the developer and the society and the members.
Okay. Under redevelopment, what will be the rate of GST on units handed over to flat owners? Is it 18% as construction service, of 1% or 5% as sale of residential units?
The law, the way it is stated, it comes out to be 5% or 1% without input tax credit. It is not defined to be a construction service, but as a sale service, sale of under construction unit, because the valuation is given to be equivalent value of the flats. And that gives the indication that the legislation treats it as a supply of a flat and not as a supply of construction service.
So if you could elaborate self-redevelopment by CHS.
So as we said, in the self-redevelopment, there is no developer. It's the cooperative society itself which will undertake the transaction of redevelopment for the members. And therefore, the question of any intention of sale, any commercial aspect involved does not come into picture. To the extent of the inventory which is sold in the open market, naturally there will be a GST, but otherwise there is no major tax implication on that.
Okay. So a few developers are paying GST on receipt basis. What are your views?
The tax is payable on the basis of demand note. Demand note basically is a note which will enable you to collect the receipt. And that's defined in the agreements. Most of the agreements would have a stage-wise payment. And on that stage-wise payment, you are required to pay the tax irrespective of whether you receive or
not. Where floor-wise part completion is obtained and sales are made floor-wise after part completion certificate, whether it will be exempted?
To the extent of part OC, it will be exempted.
So could you answer again?
To the extent of part OC, so if let's say there is a building with 23 floors and a part OC is obtained for 15 floors. If you are selling one of the flats on those 15 floors, it will be accepted as a completed sale. If you are selling a flat on the 16th floor, it will be an incomplete sale.
Okay. Whether 1/3 deduction of land portion is available in the rate?
So the rate is given as 7.5%, and once you do 1/3, it comes out to 5%. So the effective, therefore, we say always the effective tax rate is 5%.
JDA entered in service tax regime and flats are allotted to landowner in 2021. What will be the GST implications?
So the 2019 notification cannot apply to agreements entered into prior to that date. Therefore, on the date of the completion certificate, there cannot be any tax implications.
Okay. So one more question. Same, the JDA is entered in 2014. Share of gross revenue at some percent. The project is completed in 2021. Does the developer needs to pay GST on the reverse charge on unsold inventory? And if it is yes, how we should calculate the value?
I think I answered this question that because the JDA is prior to 2019, the 2019 notification cannot apply to it.
In self-development contribution received from members, is it taxable and at what rate?
So there are two possibilities here. If you say it is taxable, the question which will come is what is the service which is given by the society to the members? Definitely the society does not allot a unit. If you are talking about a developer, the developer will allot a unit. It will be transferring land, conveying the land in favor of the member buyer. It will be providing a construction service to that effect. But please understand that legally the society is the owner of the land and the structure as well. And the member is merely a tenant in the premises. If he is only a tenant in the premises, the amount which is paid is nothing but a lump sum amount towards a long-term rent of the tenancy right. If that be the case, it will get exempted under the entry renting of residential property.
Okay. So will RCM on TDR be applicable on projects which have been started before 1st of April 19 and then opted for the new scheme?
So again, I'm going back to the same thing. I think it's a repetitive question. The notification of 2019 cannot apply for transactions which have happened before that. So if you have bought the TDR before that 2019 notification, it will not apply to you.
Okay. What about the hardship or the disturbance compensation in the course of redevelopment project?
I have already answered that question earlier. The hardship or the compensation is nothing but an adjustment in the development right value. And on the development right value, you might pay tax or not pay tax as per the discussions which we had.
When the flat is booked, when project is 50% complete, can we take that 50% already completed construction is not service rendered, but sale of immovable property?
We have covered already recent.
Yeah,
Anil,
yeah.
sir.
We discussed this in detail where K. Raja does talk about it. And depending on the risk appetite, you can take that position.
Okay. Development agreement is entered in on 14th of March 2019 prior to notification, but all the relevant activities including demolition etc. happened after April 2019. Can developer pay GST on development rights on RCM basis? Can the principle of substance over the form be applicable here?
No.
So I assume when you say development agreement is entered into, I presume it is also registered. So I will read it to be registered on 14th March 2019. If the development agreement is registered on 14th March 2019, the RCM notification cannot apply.
Notices are issued on landowners for service tax on TDR on a joint development agreement prior to GST. The legal validity for the same.
We've discussed this in detail. There are strong grounds to say that there is no tax on that. Few decisions also we talked about during the session, and I think you will have to fight it out.
Okay. Any further questions? I guess I've covered all of them. GST paid under RCM for FSI, can it be claimed?
So for residential projects, as we know, there is no ITC available, 5% without ITC or 1% without ITC. So question of ITC does not arise.
Sir, in same question, if we pay this RCM liability at the beginning of the project for commercial to avail the credit, is it okay? Instead of following,
yes, there is an amendment in the notification which permits a preponement of liability in case of commercial projects.
There is ambiguity with respect to valuation, sir. In many cases, market value which we consider is the first flat sold or first commercial property office sold. So is it good to take a ready reckoner rate or the first flat sold rate?
First sold.
If we sold that with drastically less than the ready reckoner rate, it will be a colorful device or it will consider for the taxation?
So it will go on the facts. If the markets are really down and you have sold below ready reckoner value and you are able to substantiate it, it's fine. Otherwise, if the departments proves that it's a colorable device, they will have a problem.
I think most
So 2
100%.
questions can I take quickly?
Sure.
If development agreement is not registered till sale to final buyer, is RCM applicable?
I would believe this is a theoretical question because without a development agreement being registered, the developer will not have a right to get approvals from the authorities or to further sell the property to an end buyer. I think there are legal restraints on doing it. So, in my view, the question is theoretical.
Okay. So in case of TDR received by slum rehabilitation project scheme developer, whether liable for GST under forward charge, and what about free sale units?
Free sale units clearly is taxable. I don't think there is, unless you want to go back by the initial argument which we had. Free sale units pre-OC will be taxable, post-OC not taxable. As far as the TDR generated for the rehab component is concerned, I would believe there is no GST implication on that. Someone might take a different view to say that TDR is a consideration for the rehab building which has been constructed and try to impose a tax. But according to me, that's not the correct way to interpret the transaction.
Okay, so last 2 questions. Can we claim ITC on long-term lease?
No, so here you have to look at what type of transaction you are looking at. Because if your output is 5% no ITC, there is a question of taking a credit at all.
And so in case of commercial JDA, okay, he has given long-term land lease.
He has taken it on a lease, right? And he is going to use it for constructing a residential premises for sale. If that be the case, where is the question of any credit?
So in case of commercial JDA entered in 2018 and allotment done in 2022, whether GST is to be paid on development right transferred? If yes, whether to be paid by developer or the landowner?
So again, the 2019 notification cannot apply for transactions prior to 2019. So again, I think we are going into the same question. The RCM notifications cannot apply to this. If at all the tax has to be paid, it will have to be paid by the seller of the TDR, and he will have to take a position of whether he wants to treat it as immovable property and not pay a tax or pay a tax. And I think he would have already taken that decision in 2018.
All questions we have covered, sir. I just like to say a few words to all participants. Friends, transaction to transaction, we have to minutely go through the provisions, whether the word is residential, whether it is covered under RCM, what will be the time of supply. We have to refer notification number 6. For rate purpose, we have to refer notification number 3. And wherever there is no consideration, we have to take market price or the valuation rules we have to consider. Right, sir, what I am stating, transaction to transaction taxation will be different.
Yes, that's what I started with my discussion.
Yes. So this is a very vast subject, as rightly we have at the beginning we state. This is very vast because in real estate, considering all the questions of the participants, transaction to transaction taxation will differ, and this will never end. Your questions will never end because everyone is facing the different problem. Some is facing the problem of cancellation, double taxation. Some is facing the problem of market price or the classification. We have to, sir, can we share this PPT to the participants?
Sure.
Okay. Sir, excellent session it was. We can see the tax GST with respect to real estate in different angle, litigation point of view. Schedule T is not only for classification purpose, and it does not define the taxability of the transaction, and many more litigative point also you have mentioned, which I think have to be looked into while drafting the agreements or contracts. Thanks a lot for your, sir, elaborative and I think both angle you have covered, litigative and conservative. This is fantastic, sir. Thanks a lot, sir, for giving your valuable time on Sunday on a very important topic for member point of view. Thanks from Pune branch and all participants. For Pranav, please give formal vote of thanks.
Yes. Yes. Before giving a vote of thanks, a quick announcement. As Rajesh sir has already elaborated, we'll be having a 3 days virtual GST refresher course scheduled on 20th of May, 21st of May, and 22nd of May. The details of which are hosted on our portal of Pune branch. So kindly go there and register, because right now the 3 days were very fruitful for you. And I hope, because the upcoming 3 days also we have eminent speakers and very excellent faculties. And Rajesh has taken a lot of efforts in scheduling the entire the GST sessions for all of you. So I hope you take the advantage of the same. So you have anything to add on, Rajesh sir?
Regional conference we are hosting first time at Pune.
Yes.
This is in the history of WRC. WRC is giving chance to host a regional conference out of Mumbai. Otherwise, it is regularly it is hosted in Mumbai only. It is scheduled on 3rd and 4th of June. Excellent faculties, topics, everything we have planned. Structure is available at Pune branch website as well as WRC website. Please go through it. If possible, please do register. It will motivate us to host many more programs for you.
Absolutely. It will be at Bantara Bhavan, Baner, Pune. So the registrations are already open. So kindly register, because hope you get the seats as you register as early as possible, because we have already covered more than 500 registrations so far. So yes. Now, yes, Sunil sir, it was really a pleasure to have you here, and you have addressed more than 50 questions. The questions only shows that how much the participants were involved in your session and how much they were finding it fruitful, because I haven't seen so many questions, and I even haven't seen the faculty addressing to all the questions very patiently. So it's indeed a pleasure of you, sir. You took all the questions, and you took out your valuable time on Sunday morning for this topic. So I really thank you from all at Pune branch of WRC, and I hope that we couldn't facilitate you because it was a virtual session. But yes, we hope to see you soon at Pune branch. We'll definitely keep one more live session with you, and we would be welcoming you at Pune branch as well. And regarding the recordings and the PowerPoint presentations, you will be getting a mail from the Pune branch with the PowerPoint presentations and the recordings. So yes, we have the list of all the participants with the email IDs. So you will definitely get a mail. So thank you all the participants for your patient listening. Hoping to see you soon on 20th, 21st, 22nd for the GST refresher course, as well as for the regional conference on 3rd and 4th of June. So please do register.
Thank you, friends.
Thank you.
Thank you, Sunil sir.
Thank you.